A new service fee of up to $100 to buy certain ETFs on Fidelity's platform. How will this impact you? And do you know how the brokerage firm makes money when you, as the investor, pay zero commission on your ETFs? Hello everyone and welcome back to Markets with Marcus. So, Fidelity recently announced that it would charge a service fee of up to $100 on the purchase of a number of ETFs on its platform. And given the central role that Fidelity has in the financial lives of many in our Diamond NestEgg community, this had initially caused a bit of a stir in our VIP investment club last week. After all, investors are used to trading their favorite ETFs basically for free online, with many of the large brokers, not just Fidelity, but Schwab and Vanguard as well. Now, on a closer reading of the Fidelity announcement, it turned out that the new fees would not go into effect before June 1st, 2026, and apply to a limited number of ETFs only, mainly funds offered by smaller, more boutique-type issuers. Most popular ETFs from issuers such as Vanguard, BlackRock iShares, State Street and Invesco are not included. This will remain free to buy on Fidelity, even after June 1st. And while this calmed down the mood in our VIP and member zone considerably, some of our members did want to know if they might be potentially missing out on some hidden gems from less well-known boutique firms, one of which shows a 131% trailing total return as of the time of this taping, April 24th, 2026. In addition, we had a few VIP Investment Club members who also asked us whether there might be some potential conflicts of interest lurking in the whole arrangement, where Fidelity seems to punish those asset managers that do not pay Fidelity a direct asset-based fee to support their ETF's availability on Fidelity's brokerage platform. So, with that in mind, here are the three topics that we'll be covering today. 1. Why is Fidelity charging these service fees? And might there be a conflict of interest? 2. How many ETFs might be affected by the new service fee? And might you miss out on some hidden gems? And 3. What's our personal perspective on this situation? Let's get started. Why is Fidelity charging these service fees? And might there be a conflict of interest? When you buy most ETFs on Fidelity's platform, the transaction is free for you, meaning that there are no commissions online when you trade US stocks, ETFs, and options, as per their website. And quite a few of you in our community have been wondering how Fidelity can make money with such a business model. One part of the answer seems to be that for a number of years now, Fidelity has been charging issuers a direct asset-based fee to support their ETF's availability on Fidelity's brokerage platform. In other words, when you buy an ETF at Fidelity and put it into your Fidelity brokerage account, the issuer of the ETF generally agrees to share the ongoing fees with them, meaning the issuer of the ETF will share with Fidelity a portion of the expense ratio that it charges you. The exact split is not officially confirmed, but Investment News reported back in 2024, when these agreements were being negotiated, that Fidelity was targeting 15% of total fund revenue. Let's walk through an example to explain this fee-sharing arrangement. And let's assume that you buy an ETF that has an expense ratio of 10 basis points per year. In this case, Fidelity might get 1.5 basis points, 15% of what you are charged, while the remaining 8.5 basis points would remain with the fund manager. And this fee split would remain in effect as long as you have this ETF in your Fidelity portfolio. Keep in mind that these numbers are for illustration purposes only. Fidelity explains that this fee helps to pay for what it does for ETF owners, including shareholder support services, the provision of calculation and analytical tools, and general investment research and education materials regarding ETFs. And there is a certain logic to this. It will cost Fidelity some money to provide you with free trading and a free brokerage account. And it might not seem unfair to ask the manager of the ETF to help share the expenses. The new service fees of up to $100 that have been announced by Fidelity would only apply to purchases of ETFs whose providers do not pay Fidelity a direct asset-based fee, essentially to make sure they're not free riding on Fidelity's platform, so to speak. There's one potential problem though. If Fidelity earns more from some ETFs than from others, wouldn't that pose a potential conflict of interest? In other words, might Fidelity be tempted to push you, more or less subtly, towards ETFs with higher fees, because their own share would also be larger? It's definitely a worry. Respected industry publication Kiplinger, when reporting about Fidelity's arrangements with the ETF providers, articulated that concern when they said the incident reveals a lot about the pay-to-play incentive structure of the brokerage industry. In 2022, the SEC launched a probe into ETF revenue-sharing deals, specifically to investigate potential conflicts of interest arising from such payments. Now, as far as we can tell, nothing has ever come out of the 2022 SEC probe. And revenue-sharing agreements with ETF providers of the kind that Fidelity has been implementing remain perfectly legal if they are properly disclosed, as Fidelity has been doing. And, by the way, similar revenue-sharing agreements have been standard industry practice for mutual funds for a long time. So it seems you can't really avoid them. But it certainly makes sense to keep your eyes open and remain alert to potential conflicts of interest. We'll give you our personal thoughts on this later on. For now, let's move on to the next section of this video. How many ETFs might be affected by the new service fee? And might you miss out on some hidden gems? As we said before, the new service fees of up to $100 will not apply to purchases of most ETFs available on Fidelity's platform. So, for example, ETFs from Vanguard, BlackRock iShares, State Street and Invesco will remain commission-free to buy. Plus, these new service fees, even where applicable, will only ever apply to purchases, but never to sales of any ETF. And, by the way, a similar service fee on purchases has already been in place for 27 smaller ETFs from more niche boutiques since November 2025. Let's look now at the new list that might go in effect on June 1st of this year. I've linked the full list from Fidelity's website below for you as well. It contains an additional 164 ETFs, most of which are again small funds from more niche providers. However, there are some larger names on the list as well, including maybe 50 funds or so from Roundhill, a fast-growing firm that focuses on what they call thematic ETFs, funds that are built around specific themes or trends in the market. And if you're wondering what you might potentially be missing out on, we picked 7 funds with at least $500 million in assets for this table. Although, to be clear, you will still be able to buy these ETFs on Fidelity. It may just cost you a potentially steep service fee of up to $100, which, understandably, may still deter you from doing so. Please note that this table is as of April 24th, 2026, the time of this taping, and that past performance is not indicative of future results and outcomes. The list is purely illustrative and not a recommendation. You'll need to do your own research before making a decision that's right for you. In any case, we won't go through the entire list, but highlight just 2 names to give you a feeling. Second from top is a fund from Roundhill. We have already mentioned the firm before. The Generative AI and Technology ETF, ticker CHAT, CHAT. It shows fees of 75 basis points, assets of 1.4 billion, and a TTM total return of more than 130%. 131.16% to be precise. The trailing 12 months total return measures the return investors might have made from both distributions and capital gains had they invested a year ago from the time of this taping. CHAT is actively managed and includes well-known firms like Nvidia, but also less-known shares, such as from SK Hynix, a South Korean manufacturer of memory chips. And one of the ETFs that is not from Roundhill is the Brandeis International ETF here, ticker BINV. It charges 70 basis points, has assets of about $500 million, and shows a TTM total return of 29.14% at the time of this taping. Brandeis Investment Partners was founded in 1974 in San Diego, and BINV seeks long-term capital appreciation by investing in equity securities of non-US issuers that the fund's investment team believes are undervalued relative to their financial strength and upside potential. So, now that we know the underlying potential conflict of interest issue with the proposed new service fees, and have a feeling for some of the larger funds that might be impacted, let's move on to the next section of today's discussion. What's our personal perspective on this situation? Jen and I think that what we are seeing with this list of 164 ETFs that might be subject to a service fee of up to $100 on purchase is very similar to the discussions or fights that we come across from time to time between supermarkets and large food companies. These happen behind the scenes in the US as well, but are often very public in Europe. For example, when large German supermarket chains, which are famous for keeping prices low, are not happy with the conditions they get from their suppliers, they threaten to take their products off the shelves, or at least to put them at the very bottom of the shelves, so to speak. For example, just recently, Edeka, one of the largest German supermarket chains, scaled back its orders from US consumer giant Procter & Gamble when the two sides couldn't agree on pricing. Or perhaps something closer to home, when one of the large health insurance companies, let's say United Healthcare, decides that certain hospitals are no longer in network and you, as the end user, will no longer get preferred pricing if you use those hospitals. We had something similar like this happen to us with our health insurance company a few years back. We got a lot of letters explaining the fight from both sides. So, from both the insurance company and the in-network hospitals that would soon, potentially, be out of network. But in the end, nothing changed. Because after all's been said and done, after a bit of battling, so to speak, if both sides decide that they are better off with one another than without, that they need one another essentially, they usually can come to an agreement that both sides can live with after a while. This is not to say that there is going to be an amicable outcome between Fidelity and every ETF issuer that is on this list. But we wouldn't be surprised if this list evolved before June 1st. Even Fidelity itself says that the list of ETFs with the extra fees will always be subject to change. Plus, the fees will only go in effect about a month into the future at the time of this taping, which means that there is a bit of time to negotiate. especially for some of the larger ETF providers that are currently on this list. Only time will tell. So, what do we make of the situation? Well, we basically ask ourselves two questions. One, would it impact us if this extra service fee of up to $100 went into effect for purchases of all the 164 ETFs that are currently on Fidelity's list? And our personal answer here is no. This extra service fee would not really impact us much, if at all. Large household name providers are not on the list. And if we discovered a potentially interesting fund from one of the more specialized providers on the list, we wouldn't necessarily miss out, but could still do so if we paid the extra fee. And question 2. How concerned are we that Fidelity asks ETF providers to pay them a direct asset-based fee to support their brokerage platform? And our answer here, personally, is that we are also not really worried. The potential conflicts of interest are definitely something to keep in mind. But overall, we think that Fidelity has transparently disclosed its fees and revenue sharing agreements, which is always the best defense against potential conflicts of interest. And with this knowledge, it's ultimately up to us to decide what funds we buy. Remember, we are making our own investment decisions and have not delegated it to anyone else. So, as I mentioned earlier, we can still choose to buy one of these 164 ETFs with an extra service fee of up to $100 if we have a strong conviction about it. Or we can choose to buy another potentially similar ETF with no fees to us, but rather a revenue sharing agreement with Fidelity. That choice is ours to make. And because it came up in our VIP member zone. As far as we can tell, neither Vanguard nor Schwab currently have comparable service fees or similarly broad revenue sharing agreements in place. Although Schwab seems to be thinking about asking more of its ETF providers to pay them direct asset-based fees as well. But that alone wouldn't sway us personally to switch our platform, at least not at this point in time. As our regulars know, we have been with Fidelity for many years and haven't really noticed anything here that would give us pause for thought. So, in summary, we think this may be more of an irritant for investors in these ETFs, maybe, rather than a real annoyance for Fidelity customers in general. But that's us, and everyone's financial journey is different. Drop a comment below and let me, Jen, and the rest of our Diamond NestEgg community know. Do you own any of the ETFs on this list that Fidelity plans on charging up to $100 to buy? And if yes, what are you planning to do? And how concerned are you about Fidelity asking its ETF providers to share their fees with them? We would be very curious to hear. Also, let us know what other topics would you like us to cover on Markets with Marcus in the future. Thanks for watching and see you again next time.